Well, our market master of the day is Ridham Desai, and he is joining us right now from the sidelines of the Morgan Stanley India conference. His recent report, published on the 29th of May, titled "How India Has Transformed in Less Than a Decade," has been the topic of discussion and much enthusiasm since it was published. I mean, I can say that I have spoken with Ridham on markets on the air for at least 15 years, and I can say that apart from tracking micros, Ridham also zooms out and looks at the bigger picture for India. For example, earlier, just this year, he published a report titled "Why This Is India's Decade." Ridham, it is a great pleasure speaking with you. Thank you very much for your time. Appreciate it here on CNBC TV18. Let me start by asking you a simple question, Ridham. Out of all the transformational changes which you list out in your latest report, which is the one, to your mind, which will remain the most relevant for investors over the next many years? Which one is the most durable, according to you?
Hey, thank you, Prashant, and thank you, all of you, for having me here on CNBC. Glad to be back. So, Prashant, that's a very difficult question to answer, because there is never, at any time, there's never one thing that makes the difference. If you're going to push me to the wall, then maybe I would say that achieving macro stability via inflation targeting is the likely standout. But then you cannot undermine the creation of infrastructure, which is so critical to doing business. You cannot undermine the success that we have had in engineering social transfers and reducing leakages, because all these things have led to this transformation that the economy is currently experiencing. So very difficult to point out one of them, but maybe these three are standouts, and there are more, of course. And it is like if you do one thing, then you achieve one result. If you do many things, then you get a compounding effect, which is what I think India is experiencing today.
A lot of the macros have improved substantially, right? Whether it's the GST collections, the PMI data, GDP growth, even, things like auto sales, for example, come back after a long time. But do you think a lot of this is in the price as far as the Indian stock markets are concerned? Because we are virtually at all-time highs now.
Sonia, the market is not yet at all-time high, but remember the level that we are trying to cross is the one that we achieved in October 21. So effectively, we've done nothing for the past 18 or 19 months. And in the meanwhile, it's not like earnings have degrown. Earnings have only grown. I think we're ending F23 with about a 16 to 18% growth rate. So yes, in October 21, the market had probably gotten a little ahead of itself and needed to go through this really long consolidation period that we have seen. Also, it was accompanied by significant outperformance that India experienced, because the rest of the world was very much in tatters through 2022. And when the rest of the world, and when I say that, I mean emerging markets, started making a bit of a comeback in October 22, India underperformed. Yeah. And then we have suffered this underperformance until March. So I think, the all-time high is not a relevant data point in assessing how much is priced in. Rather, we should, adjust the market for expected growth rates. And it's not like that the market doesn't know that India is likely to do quite well over the next 3, 4, 5 years. But all of it will never be in the price. And the common thing that the common refrain I hear from investors is that India trades at a high P multiple. But then earnings are very depressed. Remember, profit share to GDP collapsed to 2% by 2019, is now back to 4%, but is likely heading to 8% in the next 3-4 years. So there's a lot of compounding of earnings that's still left to happen. And in that context, I don't think stocks are that expensive as they look on the headline basis. You have to adjust corporate profit margins and make them normal. And when you normalize earnings, stocks are actually still a buy.
Ridham, urban India is doing very, very well. And India definitely is on the path, and everyone's very bullish. The only problem is rural India is still in some pain. I wanted your comment on that, because it appears that, that is yet to recover, which is important from an India perspective.
So, Nigel, I think rural has probably seen the trough, and save for some really bad weather that we get in the ensuing months, and a total failure of the monsoon, like a 15% drawdown on rainfall versus average. I think in 3 months from now, you should see pretty good signs of a rural recovery. So the seeds have been sown. Coming out of COVID, rural India actually took it on the chin. urban had led the recovery, and now it's spreading to rural India. It's inevitable that rural India starts flourishing. So I am actually quite constructive on rural India, and in fact, in our recommended portfolio of stocks, we have a lot of rural players in there because we think that they should do quite well over the next 12 to 24 months.
One of the things which is a change which seems to be a change is manufacturing in India, right? Global companies wanting to set up factories here in India, and we're hearing more and more of that. It's something which we've discussed for many years, never happened, but now looks like it's starting to happen. Do you reckon, from a manufacturing standpoint, India in 2023 is kind of similar to where, say, China was in 2001? China joined the WTO in 2001, and post that growth, really, manufacturing there really took off in a very large way. Or do you think it's kind of exaggerating? It's a very different place now. And but if you do agree, what are implications for investors in your opinion?
See, there are similarities and differences, Prashant. So I think the similarities with respect to domestic demand. So I think you have to go a little bit forward in time, say around 2007, 2008, when China's per capita income was just about where India is today. It's when an economy, it experiences a J curve. So it was around $2,200, $2,300, which is where India ended 2023 at. Ended 2022 at. And that's the time when there is a perceptible shift in domestic demand. Now that is what multinational companies want to gain access to. So, one very good anecdote to cite, which everybody will appreciate, is Apple opens its first store in China in 2008. Apple opened its first store in India in 2023. And there are a lot of similarities with it. China's per capita income, China's share of Apple revenues were around 1.8%. India's share of Apple revenues are estimated at 1.6%. So that's the similarity. But that's about it where it ends. Everything else is different. So one of the first differences is the change in the global geopolitical landscape, which is driving a multipolar world, where companies at the margin are seeking to diversify production out of China and take it elsewhere. Now, India seems to be a very attractive place to go to. For one, because it has a market which everybody wants to gain access to for the next 10, 15, 20, 30 years. And the second is that there are incentives that the government is giving to overcome the cost of doing business, via lower taxes and via, production-linked incentive schemes. So that's one difference. The second big difference is where we may be in terms of global growth. So global growth was at a very different level in the previous 30 years. Now, going out into the next 10, 15, 20 years, it's likely that global growth is not as fast. The world is aging. It has a lot more debt on its balance sheet and is likely to grow a whole lot more slowly than what China did, what China experienced when it was going outwards. So, that's another thing that kind of makes India a little bit different from the situation in India, a little different from China. So India will have to rely a lot on its domestic demand, on its domestic conditions, and add on the export growth that will come to it. Whereas China, did not need to do that, given how strong global growth was in that period when China was actually adding manufacturing capacity. And the last difference is that, at the time when China was adding manufacturing capacity, I dare say that there was a lot of capacity that the world needed. Today, in a lot of sectors, that is not the case. So it will be a little bit more selective. Having said all of this, we do see India's manufacturing grow as a share of GDP. That, by the way, has stagnated over the last 25, 30 years. In fact, in many parts declined. And we see a very robust improvement in manufacturing share of GDP over the next 10 years. So manufacturing is certainly a renaissance story in India.
Okay, and just in reference to that point you were making about consumer demand picking up, right? We've seen a K-shaped recovery, and the upper portion of the K, the premium end of the market has come back in such a big way, whether it's real estate, autos, etc. I'll come to that in a bit. But Ridham, what also stands out for me in your report is you speaking about unprecedented growth likely in the financial services space. And you've put out a very helpful chart where you speak about how between 2012 and 2022, the loan growth that we saw compounded for the financial services space was just 10%. And now the anticipation is from 2022 to 32, it could be a 17% compounded growth. Now, my question to you is this. Will it largely come from the private sector banks, which are well-owned, well-identified, or do you see new spaces in financial services that one can, take the opportunity from?
So see, Sonia, with respect to financial services, let me cite the starting point. Private credit to GDP is in the high 50s, and that's fairly low compared to the rest of the world. So India is underpenetrated. India is under-levered, especially corporate India, which has experienced a pretty big decline in debt to equity or balance sheet leveraging over the past 5 years. So that sets the stage for what I would say, what I would call a loan boom. Then on top of that, I think India is entering into a pretty sustainable investment phase, because in a lot of sectors, we have not added capacity in the last 10 or 12 years, and capacity utilization is rising. So that again supplements the case for a loan boom. So we should experience pretty much higher credit growth than what we have seen in the last decade. Not at the level which we saw in the first decade of this millennium, but much stronger than what we've seen in the last decade. Because in the first decade of this millennium, the starting point was even lower. Corporate debt to GDP was just 25%. Today that number is about 50, down from around 62, 63. I think by the time we are done and dusted with this cycle, this number will go into the 80s. And when you just do a simple math, if that share of corporate debt to GDP is rising from say 50 to 85%, plus personal credit is rising, and GDP growth is say 10%, you arrive at this number of around 17% compounding. So that's one aspect of financial services. The other aspect is non-credit related financial services. That will also see, I think, much larger penetration in the coming decade. So across the board, I think financial services should do fairly well over the next 10 years. In fact, I would say even longer, but we are not going beyond the next 10-year period. So the next 10 years look like a very good period for financial services.